Hello friends, welcome back to my channel. This is Abhijit Roy. Those who don't know me, myself Abhijit Roy, I'm an ex-banker of 20 years and currently I'm trying to make you understand financial thing in a very layman language. Today friends, we'll discuss all our debt funds and debt funds against fixed deposit. What are the advantages of debt fund against a fixed deposit or maybe vice versa. So before we start, I should ask you to have a pen and jot down some points because it might help you in a long way. Right. So when we speak of debt fund, what are debt mutual funds? Debt mutual fund invest a significant portion of your money in a fixed income securities. Fixed income securities like government securities, debentures, corporate bonds. You have other fixed income securities also, right? So debt funds basically buys bonds and earn interest income on the money. Debt funds do not offer assured return. Right, you have to understand it. They don't offer you assured returns, but have market-linked returns which can fluctuate. So, in case of rising interest rates, you will often find that there is a positive impact on the debt fund, and vice versa for diminishing interest rates. So, if we speak about what are the types of debt funds that are normally comes in, right? So, you will have liquid funds. Liquid funds are basically highly liquid funds which almost all maybe you will find a lot of corporates or a lot of businessmen invest their funds in a liquid fund also to help them grow. You have a short-term fund and also long-term and medium term plans. This is the second option. What do you have in a short debt mutual fund? Basically, there's a maturity plan of a period of 1 to 3 years, right? Since these funds are suitable for investor with very conservative or low risk appetite, so as the prices are not much fluctuation, the prices don't do fluctuate as often as other debt funds. You will also have medium mutual funds, medium debt mutual funds basically. So out there typically the portfolio maturity is of up to 3 years, and you have a long-term debt fund where is a portfolio maturity is of 5 years, right? So in this there's a bit of riskier than the short-term debt mutual funds. You also have dynamic bonds. Dynamic bonds are nothing, as the name suggests, is nothing but a fund where the fund manager changes the maturity of the portfolio according to the forecast or probably according to the forecast of the interest rates. So I think these are the various mutual funds or debt mutual fund where you will find. You also have a fixed maturity plan that is also commonly known as FMPs. The FMPs comes with a lock-in period and they don't promise a every return, but they can get a good return also. So these are the few debt mutual fund which are normally offered. You will also definitely have different segments out here. So these are certain debt funds which you should know, right? So debt funds are basically more suited to an investor that are interested to avail with a higher return with a moderate risk, right? It is a less riskier than a equity mutual fund. In case someone is investing in an equity mutual fund, it might be a more aggressive funds. So next questions comes how to choose a debt fund, right? How you will think what are the best suitable things you should understand or where you should invest. So first of all, you have to understand the investment objective. What is your investment objective? When you want to redeem this fund, whether it's within 1 year, whether it is within 3 years, whether it is 5 years, accordingly you should invest in debt mutual funds. And as far as taxation is concerned, please consult with your financial advisor to get a proper view on your taxation on the debt mutual funds, right? Now we speak about fixed deposit. What is fixed deposit? Like from 2002, if you see the interest rates out there at that point of time, fixed interest rates rather, it was around 11 to 12%, right? Then around 2014, it came down to 8%. Around COVID time, you will find around 4%, 4.5% was the fixed deposit rates. Now after post-COVID, you will find that a lot of interest rates there's a lot of shifts, and currently you will also find FDs that are coming up with 7%, 7.4, 7.10. There's a good interest rate. The main advantage of a fixed deposit is the liquidity, and it is also assured return, which is provided by the bank. Because what happens is since banks are governed by RBI, so they will definitely give you this fixed deposit rates. Clear. Again, if you see if what are the things you can see in terms of how mutual fund can beat the fixed deposit, if we speak about. In case of mutual fund, debt mutual fund, there's a massive selection. Like you will have a lot of selection in terms of what are the options you will get in terms of debt mutual fund, right? So I hope this short video will be liked by all of you. In case you like this video, please do let me know. And in case you like this video also, I will request you to subscribe and like my channel. Thanks a lot.